What's up, 360 Elite Trading Course? It has been a while, but I am back, 360 in the house, and it is time. I'm so excited about the series we're getting ready to do. And the series we're getting ready to embark on is going to be the classical chart patterns, the classical technical analysis chart patterns. Now, here's the thing. You're going to think you know them. As a matter of fact, these are the most abused, misused parts and aspects of technical analysis in the business. I dare say that 75 to 80% of those talking about these patterns actually do not know what they're talking about. So this is probably going to be about a 5 or 6 part series. And today's chapter is going to be on the head and shoulders, or the inverted head and shoulders. And I'm going to tell you right now, this thing gets absolutely abused daily all over Twitter. I mean, people think they see it. I mean, they look in the sky and they see it. They look on the ground and they think they see a head and shoulders. Head and shoulders, inverted head and shoulders, head and shoulders. You hear it all the time, and 9 times out of 10, it's not. It's absolutely incorrect. Now, even for those of you who are experienced traders, you're probably going to hear some new stuff. You're probably going to hear, because I'm going to dispel the myths, the rumors, and you're going to learn the true facts and secrets about head and shoulders and how to use them to the best of your ability so that you are trading with the odds in your favor and so that you have the best chance of it succeeding. So that's what we're going to discuss today. Head and shoulders, inverted head and shoulders. And as you know, or those that don't know, inverted head and shoulders is basically the head and shoulders upside down or flipped on its tail. So let's just get started. Most people, let's do the highlighter. Most people are like, yes! Every time they see this somewhere in a chart, head and shoulders, head and shoulders, head and shoulders. Every time they see this, something like this up here, it don't matter where we're at in price action it is, they are like, oh, that's a head and shoulders, that's a head and shoulders. And then they get this one. Here's your inverted or upside down head and shoulders. You know, here's your left shoulder. Let me get my arrow. It's easier for y'all to see. Left shoulder, head, right shoulder. Here we got the left shoulder, the head, and then the right shoulder. And people assume that when they see that they have a head and shoulders. Wrong. Wrong, wrong, wrong. There are underlying factors and underlying price action activities that must be taking place in order for you to say this is in fact a head and shoulders. And then it still has to validate itself. It still has to validate or invalidate itself. So there must be things that happen before it, things that happen during it, and then a confirmation of such in order for you to call it or give it the label of head and shoulders. So we're going to actually discuss that and dispel some of these rumors, but I love it. I mean, it is what it is. Let's talk about one of the first things that we need to know about a head and shoulders. As a general rule, and in order for you to trade with the odds mostly in your favor, it's important to know that head and shoulders or inverted head and shoulders are reversal patterns, reversal type patterns. That means the market is already trending in a direction, not consolidating, not moving sideways, but it's actually trending in a direction. So here we have an uptrend, okay? We got the market moving up, pulling back, moving up, pulling back. You know, you got to have at least 2 of those to actually say you're trending. And by the way, this can you can do this on many time frames, and this is one of the very important things I want to mention about head and shoulders. The higher the time frame that you see them on, the more valid they are. Okay, spitting out a head and shoulders on the 1 minute or the 5 minute chart. I'm not saying it can't work out, but the odds are much lighter because these things take time to develop. Head and shoulders patterns, for reason of supply and demand, they take time to form and time to develop. And so most people that are looking for these valid patterns will try to look for them on the hourly or higher, and you daily, even weekly. But the higher the time frame that you see them, the better odds of your success for that to work out. So here we've got this uptrend going on. Now. So you must have a trend intact before you get your head and shoulders. There must be a trend already intact. Remember, it's a reversal pattern. It's a reversal pattern. So if you see one, market going sideways, and then all of a sudden you get one, it's in a consolidation. It's been in a consolidation. That is not a head and shoulders. It's just not the case. So it must be in a trend. And then again, on the downside, you could be trending down. Boom, boom. Okay? And now you have a uptrend here. Here you have the downtrend. You have your left shoulder, your head, and then you have your right shoulder. So it's, again, it must be coming in at the end of a trend of some type, whether that's on the hourly, the daily, or the weekly. It is a reversal. Overall, it's a reversal pattern. Now, could you trade it as I get this question often, can it be traded as a continuation pattern? So that's not its original design, its original intent. And what I would tell you in that regard is to take it lightly. I would definitely make sure every rule of volume is there, and I would definitely focus more on my loss prevention if I was using it as a continuation pattern, because that's not its intent. I need to clarify that and be clear. It's not that you can't. As an advanced trader, you could definitely use it as a continuation pattern, ensuring that it's following the rules to the T and making sure that your loss prevention strategy is the most key and most important thing. But I would not rely heavily on it for that, because it is in fact a reversal type pattern, a reversal type setup. So I want to show you, let me undo this. Let's get rid of this stuff. And let's talk about the head and shoulders. Okay, so let me draw this for you. Let me get my highlighter. All right. There are different types of head and shoulders, and this is very important that you get this. You're going to see 3 different types of head and shoulders, and that correlates also to the inverted head and shoulders as well. 3 different types of head and shoulders, 3 different types of inverted head and shoulders. And we're going to talk about which ones are the most effective and which are the least effective. All right, so let's draw one. This is like your picture perfect head and shoulders. I mean, it's like, what is that? Everything is very perfect. You got a perfect left shoulder, a perfect head, a perfect right shoulder, and they equal each other, and it just looks perfect. All right, this is rarer. It's very rarely is it ever perfect. But believe it or not, this is not the most effective or reliable head and shoulders. It is not. It is not. It is not. So let's look at another one. All right. So we already know, let me get my arrow. We already know left shoulder, head, right shoulder. Everybody's pretty much got that figured out. Left shoulder, right head, right shoulder. This is a symmetrical. That's the word I was looking for. This is more symmetrical in nature. And this, and then, if you're going to have a head and 2 shoulders, and you've got to have a neckline. So here, it would look something like this. You have a pretty horizontal neckline on a symmetrical head and shoulders. It's pretty much horizontal, almost perfect. Look at this down here. This is a more of a descending head and shoulders. A descending head and shoulders. I'm going to draw one more. All right. All right, we got our 3 up there. I did it. Woohoo! Symmetrical. Descending with a descending neckline. Descending head and shoulders. And we have an ascending head and shoulders. So being that this is reversal, the trend is up. So the trend coming into each of these is up. We have already identified that. I'm not going to draw it on here. So the market's moving up and then it moves into one of these. Which one of these 3 do you think is the most effective, most reliable? Remember, we're expecting price to go down. We're expecting price to reverse. We were going up, coming in. Now we're wanting price to come down, coming out. Out of these 3, which do you think is the most effective? I'm going to give you a second to think about it. How many of you said the descending one? Well, price is going down. This one already is headed in that direction. Wrong. Wrong, 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 wrong. No, this is not. This is not. This is actually the least. This is actually the least. This is the middle, and this is the most effective. This is the most effective. And now I'm going to show you why. I'm going to show you why. Let me get rid of some of this. All right, let me get rid of this. So let me bring something over, this picture here. All right, here we go. Bring this in, and let me bring in another one real quick. I love this stuff, man. This stuff right here is what it's all about. Let me grab this. All right, I think we are good. All right. All right, there we go. This was a little blurry. Sorry about that. All right. The ascending head and shoulders is the most effective. And the reason, and this is why most people get head and shoulders wrong, is because they don't understand price action first. The whole goal of technical analysis, and I've tried to teach this to you throughout the course, is for you to understand what exactly is going on in the psychology of the market. What exactly is going on in the head of the buyer? What exactly is going on in the head of the seller? When you look at a chart and you look at candlesticks, that's what you should be trying to determine. And most people just think it's all about the pattern and that's it. As long as you got the pattern, hey, that pattern's bullish, you're going to trade it. And that pattern's bearish and that pattern's bullish. Well, that's not the case. You need to understand everything underlying that pattern and why that pattern presents itself the way it presents itself. Just being able to draw head and shoulders doesn't mean jack if you can't explain the activity behind it. So now I want to explain why this is the elite or the most effective. I want you to see this. So here you have the trend coming up. You can imagine this is going up, going up, going up, coming in, and then we create this left shoulder here, and then we move on and recreate a higher high right here, higher high. Where are these trend traders and these traders placing their stops? Where are they placing their stops as this goes up? They're putting it below these pullbacks. They're putting it below these pullbacks. So all of your longs are protecting their longs by placing their stops below these pullback areas. So watch what happens here. Now we go into this head. So according to them, the trend is still intact. Now on this dip, note, this dip does not take out the long stops, the stops of the longs. So all of your longs are still in the game. Most of your swing longs are still in the game. So on this drop, they have not been taken out. They all still have their positions. And so on this bounce right here, you now form the right shoulder. Remember, all these longs are still in. All these longs are still in. Now, when this descends and breaks, and starts to take these guys out, you have max pain. You have max pain. Because now all of these guys that stayed in, they all stayed in because this low was never taken out on this dip to create this right shoulder. So they're all still in. And once they get taken out, it increases the pressure to drop the price to take out the rest of these stops. So this one gets taken out, driving pressure down to take out the next one, and so on and so forth. And so you have a max power drop on the downside. Now, what happens here is your big money is unloading up here. Your big players are unloading up here. It takes them time to unload. So they need this consolidation up here. They need this consolidation. As a matter of fact, it forms a beautiful triangle of consolidation. This gives big money time to get out before everybody else does. So they're selling these highs. And without giving it away, because if they were to sell big money, your whales, your big players were to sell everything right here, you'd have this massive volume spike, and you'd probably take out this low, and you'd probably have a lower low here, and then a lower high. So to have max pain and to have this work out most effectively, big money begins to take out here before anybody else knows what's happening. Before all these longs knows what's happening, before they can get stopped out, before the market can tank. So big money is selling into these highs because big money sells high. They sell high. And then boom, once they're done, this price drops. All these guys that were long that did not get stopped out drive that price down, push that price down, and you get max destruction. This one's blurry over here, but you can see left shoulder. Head, we have the ascending neckline, which is what you want. This is high probability. So your whales are selling on these highs without giving away the game and without taking out these longs. So all these longs on these pullbacks, they're still in the game. Their stop is below here. Once you get that, boom, you get a cascading effect. And it just plummets. Versus this guy. All right, and I'll tell you why. It's the opposite. So on this dip, because it came lower than this one, it's already driven out a lot of the longs. They're already out. So this pattern is going to be less effective because a lot of the longs, in order for you to have the massive drop, you've got to take out longs. Well, a lot of them were already removed here on this first dip. A lot of these longs have been stopped out of the trade. So you have less power on this downside. There's less chance of heavy momentum pushing down. There's less profit potential pushing down. Much less on that. So that is the reason why that ascending neckline is better, is what you want, is what you're looking for. Now, I want to talk a little bit about volume, because volume has everything to do with what's happening. Let me bring this picture back. All right. Here we go. All right. I'm going to open this up a little bit so y'all can see it. All right. Now, let's talk about volume. Again, unless the volume fits the profile, you do not have a head and shoulders. Unless the volume rules fit the profile, you do not have a head and shoulders. So that's why I'm saying you can't just see it and say head and shoulders. There's many rules of thumb that have to apply. So here we have our uptrend coming in. All right. Boom, we bounce off here. Now, volume coming into this head right here should be lower than volume coming into this left shoulder. All right, you want the volume coming into this left shoulder, and we're going to look at this on a chart. I'm going to let you see it, but you want this volume, this green volume, to be higher than the buying volume here. Why? Because you want to see that this is losing steam. Remember, if this is a reversal pattern, then it needs to be losing steam. If the volume's increasing on the head, the odds are that you don't have a head and shoulders. You know, if the volume picks up here, well, that's not really what you want. You need this to be losing steam into this high. You want the chart to be lying to you. You want the chart to be telling you that the price is going up. However, the buying is exhausting. The buyer's volume, the amount of buying is starting to dry up. So, nice green coming into here. You want this green volume to be lower. Then, on this rejection here, you want this rejection to be high. I like this to be high. Now, it's not always going to be mega high. Okay? So this dip volume, this red volume will probably be relatively low. I love for this dip volume to come off of this high. Why? Because it shows a rejection of these prices. So you have a drying up of buyers with a strong rejection off the head. I love for this red volume on this dip to be higher than the average over here, than this dip and this dip. I like this to be higher. Why? It's more confirmation. It's more confirmation that sellers reject this price. The odds of this not holding up, the odds of this price not holding up are slim because the sellers came in strong here. So I like the sell volume coming out of the head to be high. The rest of this volume here is going to be low. You want this to be low. All right. Again, buying, you want the buying volume to be low. All right. You have it lower here and you have it low here. A lot of times the volume on the right shoulder is pretty low all the way across the board. All the way across the board. Buying and selling, it's usually low on the right shoulder. Until when? Until you get your breakout. You want to start seeing an escalation of selling volume coming out of that neckline. You want to see the selling volume escalate coming out of that neckline. That's what you want to see. And then you get your plummet. All right, so what can happen after the neckline break? Well, A, it can break and run. So you can just get a break here and off it goes. Or B, as happens with many breakouts. Oop, lost, there it is. You can get the breakout and the pullback to retest and then the real move. So how do I trade this? A high risk entry. Let me get another arrow. A very high risk entry is to trade the first drop coming off the right shoulder to short here. That's a very, very, very high risk. And you'd want to keep your stop probably right above that right shoulder, nice and close. But you would be shorting off of a rejection here. Off of a rejection in this area. So somewhere in here, as this is plummeting down, that's a very high risk. Why is it high risk? Well, because it has not confirmed. Confirmation comes on a break of the neckline. So if you're not high risk, if you don't have the money, you don't know what you're doing, you don't know how to prevent your losses, I do not recommend that. I recommend either waiting. You have two other shots here. Either waiting and buying the breakout, knowing that it may come back and retest and you may have to wait. So you can buy the breakout. Short the breakout. You can short the breakout, or you can take a risk of waiting for the pullback and then waiting for the bounce off of the neckline and then short there. So 3 shots. High risk off the right shoulder bounce. You could play the break down below, the breakout below and short that. Or you can short the retest of the neckline. It's that simple. So real quick, let's talk about how you get your target. Your target is measured from head to neckline. And then you just take that distance and you flip it. And you flip it. You want to measure it better than I just did. I'm just trying to show you how to do it. And this is your estimated target right here. Bang. That would be your estimated target. How heavily do you want to rely on that? Very cautiously. You want to take everything else that occurs after this into account. Yes, you can draw up the schematic. Yes, you can get the breakdown, the retest, the move. However, you want to watch volume, watch momentum. If it begins to fade, before the neckline, you may want to take profits before. You don't have to write this in stone. You don't have to write this in stone. Sometimes it stops just short. Sometimes it blows past it. But this is your estimate. Remember, this is an estimate aggregate of where you can expect price to come close to reaching. That's how you get your target. As measured from neckline to head. As measured from neckline to head. All right, let's take a quick look at... Let me get rid of some of this. And let's pull up the inverted. All right. I'm going to open this up so you can see it better. All right. Again, as the ascending neckline was the best one for the bearish reversal, for the bullish reversal or the inverted head and shoulders, you want the descending neckline. Same rules, but opposite. Note how this bounce. Note how this bounce does not take these shorts out of the game. So these people are shorting this. They're putting their stops right here on these bounce highs. They're putting their stops up here. They're shorting. Stop is placed. Boom, it keeps going. Stop is placed. It keeps going. This bounce off the low does not take out this bounce high here. So it does not take the shorts out of the game, meaning we now have max pain. Everyone is still short. Everyone is still short. Meanwhile, I love this. I love when I can put two patterns together. Meanwhile, smart money, big money. Let me fix my arrow here. Big money is unloading their position, and it takes them time to do so, and they want to do it without giving away the farm, without letting everybody else know. So they began to distribute. This is a distribution pattern within the head and shoulders in the form of a triangle. They're distributing this. They're getting rid of, they're selling these highs, these bounce highs, without taking out everyone else that's short. They don't want to give it away. It gives them an opportunity to get higher sells, better sells. Once they're out of the game, then they short it. Or excuse me, then they go long. This is inverted, so this is going long. So again, here you have the neckline break. You could take a long position on the break. You could take a long position, a high-risk long position. As I showed you before, wait for this rejection here and wait for a nice green candle off the right shoulder, and you could take a high-risk entry here. You'd be in long before everybody else. You'd need to play your stops very, very tight. And then bang, you could take advantage of this. Or those that are really risk-averse can wait for this pullback and wait for a green candle off of this neckline and go long here. From here. But notice how I'm able to explain to you what's happening between buyers and sellers, between longs and shorts. I can tell you what's going on, who's in the game, who's not, why it's important for those longs and those shorts to still be caught dead-handed. Because it sets up, when all of these shorts are still in the game, it sets up for a short squeeze or a very explosive move. A very explosive move coming out of this distribution consolidation. and you have a much higher chance of much higher probability trade, a much higher chance for bigger profits than you would if you had one of these. All right, because all these shorts have been removed or taken out of the game here. They've all been taken out. All these people that were shorting, that had their stops here, they got taken out before the right shoulder could be created. So that's pretty much self-explanatory. And let's see here. Let me pull this up for you. All right. Hopefully this one's not blurry. So here we go. This is what it looks like on candles. Remember, this is a reversal pattern. So you have over here, you have to imagine. Let me draw it for you. That price is coming down, trending. You have some type of downtrend coming into this inverted head and shoulders or upside down head and shoulders. You have your left shoulder, your head, your right shoulder. You want sell volume to be high, coming in here, much higher than the sell volume coming into the head. Why? Because you want to see that the sellers are drying up. High sell volume, not quite as high sell volume. You want this to be diminished. The more the merrier. Because it shows what? Hey, it says the chart's lying to you. We're making a lower low, but the volume has dropped off the face of the earth. So the sellers are exhausting. They're exhausting. Big money starting to unload here, but they're unloading in pieces. So they don't let it take out all of the shorts, or they don't reveal what's happening. So it bounces and then they sell again. This could happen. This could even happen a couple times here. They sell again. And you can see it. I like for y'all to see this. This triangle, it's a consolidation and it's a distribution triangle within an inverted head and shoulders. Then you get your breakout. And you get kind of a retest here, kind of pulls back, doesn't really touch it, and then off it goes. And then off it goes. So as a general rule, where do you put your stops on this bad boy? Well, I'm going to tell you right now, if you went with the aggressive entry, you're not going to give it much wiggle room. You're pretty much going to have your stop right here. Those that play, as a general rule, almost everyone is playing their stop below that shoulder, that final shoulder. In order for the head and shoulders or the inverted head and shoulders to be one, it must confirm by having a neckline breakout. If you do not break the neckline, then it invalidates. Like, let's say price comes back here and tests this, and then it comes this way. It is invalidated. It has invalidated. So to play with the odds in your favor, recognize what's happening. No, see it in the volume. You can see all of this happening in the volume before and during the creation of the right shoulder to give you a probability. Now, to increase the probabilities, get your neckline breakout and then go long. And then go long. And then those that are very risk averse, you can wait for that pullback retest. Wait for a rejection candle. Wait for it to bounce off of that and start heading back up. And then you'd want to enter on that candle. So I want to go a little bit further into the volume. So I'm going to pull up a chart that has it. Let's see here. Let's pull this one up. All right. Just look at the volume profile on this. I want you to see this. All right, first of all, we do have on the inverted, remember the high probability one is the descending neckline. The descending neckline. On the head and shoulders, it's the ascending neckline. That's the highest probability. So check this out. This is brilliant volume-wise. Look at the sell coming in here. You want the selling to be high. Look at the sell volume coming into the left shoulder. High. Look at the sell volume coming into the head. Lower. High on the left shoulder. Lower. Coming into the head. That's what you want to see. That's what you want to see. Remember I told you I want to see a hard rejection off of the head. Look at the buy volume coming off the head. It's beautiful. It's brilliant. That's what you want to see because it validates that this is a strong demand level. It's strong demand when you have volume come in at high like this. High sell volume right here. High sell volume coming in, higher than coming into the head. Love it. Beautiful. High buy volume, high bounce volume coming out of the head. Beautiful. You have it. And then things calm down on the right shoulder. They calm down until you get your breakout. Here we kind of have a breakout with a retest. So we do have some volume climb here on this move. We do have some volume climbing on this move. So we're waiting for what? We're waiting for a boom blowout right here off this neckline with volume is what we're waiting for. But I wanted you to see this volume pattern down here, this volume setup, so you can understand volume better because the volume rules must apply. 90% of people talking about head and shoulders, cup and handles, and all of these class patterns never say a word about volume. And yet you cannot have a head and shoulders without the volume rules applying. They're applicable. They go hand in hand. One without the other is like having half the book. If you have half the book, you don't have the book. Period. That's how it is. That's the way it is. I'm going to tell you right now, you can go Google and go read about head and shoulders, inverted head and shoulders. 90% of the lesson plans out there are incorrect. They're wrong. Absolutely wrong. And I'm telling you right now, 60% of them don't even mention volume, which is absolutely asinine. It's crazy. It's insane. It's absolutely disgusting. All right, you guys got it. You know what it is. You know how to do it now. Don't be calling everything that looks like a head and shoulders a head and shoulders. Know which head and shoulders have the highest probability and the highest profit potential and know why. Be able to explain what the buyers and sellers are doing. Be able to say where the supply is, where the demand is. Be able to say things like supply is drying up, demand is drying up, sellers are exhausted, buyers are exhausted. Be able to see that because that is what is underlying everything else. Otherwise, it's just drawing lines. It's just drawing patterns and they're worthless. They're worthless without the detailed explanation of what is happening with market psychology, and that is the battle between buyers and sellers, winners and losers. Boom! Next week, baby, we're going to tackle cups and handles. Love ya.